Penny stocks turn your pennies into dollars. Penny stocks turn your pennies into dollars. We've all heard about the investor who bragged about his 100% or 1000% return on a stock, or about the guy who made it rich by investing in small caps, undiscovered stocks that made it big. In theory, it seems to be too easy. Invest in a couple of penny stocks, then sell them when they move up. Unfortunately, it is too easy. It's usually best to avoid trading these stocks. If you feel that the temptation is too much, wait until the stock begins to rebound. If you try catching a falling knife, you will get hurt. New startups every year. There are hundreds if not thousands of companies who decided to go public. Whether they need the money to expand their business, or are looking to cash out their equity, it's a natural progression for a company with a compelling story and a great track record to go public. Often, the information is sketchy at best, and typically, it's biased. You should expect the shareholder to say good things about the company. If the company didn't have potential, they wouldn't be holding it. Or, they might be hoping to unload their shares and hope to talk you into buying. Stocks listed on the OTCBB file annual and quarterly statements. The key is to identify the companies whose management has a record of consistently making money, or at the very least, delivering on their business plan, and decreasing expenses. Penny stock newsletters. Being a writer for the leading source puts me in a biased position when speaking to penny stock newsletters. Here's what I can tell you: be careful. Check the disclaimer for the amount the newsletter is being paid to carry the profile. Are they being paid in cash or in shares? You'll likely find a correlation between the number of shares they are being paid and the rating on the hype meter. No. Just keep in mind that they are selling a story, and if they sell the story to other shareholders, they will gain. This is not a problem if you get in early, but could be a problem if you aren't able to jump in right away. Take a look at the track record of the newsletter. Have they profiled winners? Do they state the facts, or state the hype? Of course not. Think of the payment as advertising. They are promoting the company and trying to get exposure. Like any company, the only way to get exposure is through some method of advertising. So don't dismiss a paid profile as hype. Keep it in the back of your mind while you are reading the profile, but pay attention to the profile. You may find a diamond in the rough that no one has discovered. If you want to make money, you have to be able to buy and sell enough shares to lock in your profit, or protect your capital. If ABC Company's daily volume is only 500 shares a day, it may take you several days to accumulate a position worth taking. If there's bad news, who's going to buy your shares? If the volume is low, stay away. Look at a company, take a look at what their business plan was, and confirm if they have followed through on that plan. Were they successful? Did they bring a product to market on time? Did the company follow through on its acquisition strategy in the manner they set out? The hype might get you a quick pop, however, unless you are watching your trading screen every second of the trading day, you will miss out. Size matters. There are thousands upon thousands of penny stocks. While this may not seem like much, keep in mind that it's not unusual for a 10-cent company to drop to 5 cents. That's a 50% loss. If your position is $10,000, a 50% haircut leaves you with only $5,000. Keep your losses to a minimum. If the company has done well, and you are up, either take your profits off the table, or add to your position, and be sure to reset your stop loss, so as to protect your previous profits. What are your reasons for buying? What is your exit strategy? Where is your stop loss? At what point will you take your profit? Write down these answers before you place the buy order. Penny stock investing can be profitable. Remember, you are taking larger risks than you would if you were purchasing shares in a bank stock.